80 has only seen declining or ultra low interest rates, and I think that's over. And I note in particular the period from the beginning of '09 when the Fed took the Fed funds rate to zero to fight the global financial crisis, to the end of 21 when it gave up on inflation being transitory and decided it had to raise rates to fight inflation. Over that 13-year period, remarkably, the Fed funds rate, which is our primary barometer of short rates, was zero most of the time.
Yeah.
So people are biased to think in line with what they have lived through recently. They think that's normal. And when rates were so low, just go back 3.5 years to the beginning of 22. Cash paid zero in the bank. Um, Treasuries paid one something. High grade bonds paid two something, and high yield bonds paid four. So, nobody liked these things. In fact, they were, as you say, attracted to the stock market. The S&P 500 has returned 10% a year on average for the last century. That's enough to turn a dollar into roughly 15,000. Not too bad. So people got into the habit of buying stocks regardless of valuation and ignoring bonds because of the low yields. Things today are very different. Today, the Fed funds rate is 4.5. The 10-year Treasury yields 4.5. The 30-year Treasury yields close to 5. I wouldn't recommend it because it's too subject to shocks, including inflation. But these are much higher yields, and the things we do, like high yield bonds, yield in the sevens, and so forth. That's pretty good. Now, for the individual, to start biasing your portfolio more towards defense and less towards offense. I'm not saying get out of the markets. I'm not saying don't have investments. And uh, I'm just saying maybe you should shift some of your investments towards uh, lower returning things, which offer more safety.
So I want to ask you, because that's a really good frame for people to be thinking about. And this is all, people will even ask me, I don't give financial advice for a living. And people will say, what should I do? It's so deeply personal for so many reasons. So people can take that frame. It's a beautiful thing. They can go figure it out. But overlay on it, Howard, in all of your decades of watching the credit market, the equities markets, and understanding how the fundamentals might work and all the nuances of the humans involved. We now have one particular human who's very involved. And I actually wrote a thing last week that some people would think was hyperbolic that said, the day that the US government took a 10% stake in Intel is arguably the day that capital markets died as we know them. And the reason I said that is not because governments can't take stakes in companies. It's because the CEO of that company didn't raise a fuss. There could have been a legal pushback. There could have been a PR pushback. Instead, we're seeing Intel, NVIDIA, AMD, big companies.
You have a promise of interest and a promise of getting your money back at the end. And if the bond issuer, the borrower, doesn't keep that promise, they go through bankruptcy and the creditors get the company. So they have a lot of incentive to do so. Um, and so we have our sector in the industry. Our sector is called fixed income
Mhm.
because the outcome is fixed. And so today you can get, let's say, 4.5% from a 10-year U.S. Treasury with, I would say, 100% certainty, and let's say 7% from high yield bonds with 99% certainty. That's been our experience so far. 99% have paid every year. Those are decent returns, fully taxed. I wrote a memo called Ruminations on Asset Allocation roughly October of last year. And I said there are two kinds of asset classes, owning and lending. I think you do a good job, Amanda, of putting things in simple terms. So I'll try to emulate that. Your brother in law uh, wants to start a business, and your spouse says you have to give him money. You have two choices. You can lend him money in the hope that he'll pay you interest and you get your principal back at the end. You're not involved in the business. You don't rise and fall with the success of the business, but you hope to get repaid at the end. Or you can become a partner, and if he kills it, you do well, and if he does terribly, you lose all your money. Ownership or lending. Stocks are ownership, bonds are lending. Of a low return or a negative return or a total loss. Uh, so every investor at every point in time has to ask themselves, what do I want? Do I want to maximize my potential return, or do I want to minimize the uncertainty I face? You can't do both at the same time. Oh, I said in one of my books that people come to me for financial advice, friends, and they ask what they should do, and I say, well, which is more important, uh, to keep what you have or make more? And what did they say? Both.
Yes. Yeah.
You can't maximize both. You can't maximize the probability of increasing your wealth and maximize the probability of holding on to what you have at the same time. Everybody has to make a choice, and I think it's reasonable to alter your choice as conditions in the world change.
Let me ask you, as somebody who's been doing this for so long, who's been watching so closely what's going on politically in your country, geopolitically around the world, with tariffs, with changes in behavior around how capital markets function. Will we ever revert to normal? Will the U.S. market go back to normal, do you think? Or is this just a new era where we just need to accept that there will be uncertainty and change and maybe even inflation and tariffs and all the rest of it?
I think we can go back toward normal. I think that President Trump does not consider himself bound by convention, norms, or what his predecessors did. So he's willing to do things like
Markets. Is that a fair statement?
well, when you say the market, I'm